Hello, everyone, and happy Tuesday. Guess what day it is? It is Mortgage Tip Tuesday. Always remember, another Tuesday, another tip. With this, your girl, hashtag JLoan. I'm coming at you, going to give you some tidbits on the topic this week is debt to income. And what brings me to this topic is a borrower may say, goodness, I am paying $1,700 in rent. Why can't I qualify for a home loan of the same amount? So I want to break down debt to income, how we calculate it, and maybe go into a little bit of what's included, and try not to make this so long, but it is going to be super helpful. That hopefully it'll help you, your family members, your friends, your clients, or someone that is looking to purchase a home. So I'm going to go ahead and share my screen real quick because I have a little what I'm going to work off of, and I want you to see that. So here we go. All right. So we're going to talk about debt to income. And the first thing that we really need to understand, and you would be surprised how many borrowers have no clue what this is. But before you come to us, it's very important to know how much money do you make a year, all right? And whether that's hourly, whether that's salary, whether that's commissioned, whether that's self-employed, whether that's second employer, let's break down your income just a little bit. So if you're hourly, great. You want to take your hourly pay, multiply that by your hours that you are guaranteed per week. It doesn't matter that you work 42. It's what are you guaranteed per week. So if that's 36 or 40, you're going to multiply what you make an hour times that number, multiply it times 52, and then divide by 12, okay? If you're on salary, this is easier as you just take your actual salary, don't include overtime, bonus, and commission. So whatever that salary is, divide that by 12. As lenders go by your gross income, we don't go by what you take home. So what we're looking to figure out is what is your monthly gross income. Now, where it gets a little tricky, and every program in itself is different, but the general rule for overtime, commission, second employer, so someone who may work two jobs, self-employment, I think I said that already. Well, where it comes into play, if you make any of those pays, bonus, overtime, second employer, or self-employment, is a lender cannot use that pay unless you have been on that job or have received bonus, overtime, commission, self-employment pay for the past 2 years. The biggest thing is making sure that we can average that over 24 months. So even if you're receiving more money now, they look at an average of that. Now, part-time employment or second employment, second employment, if you haven't been doing that for 2 years, we can't use that income. So I ask people, sometimes clients come to me and say, well, I'll just get a second job to help me qualify. That sounds great. And maybe at one time that was acceptable, but the guidelines now state that you have to show that you have consistently worked 2 jobs for us to be able to use that income. So although I don't discourage it though, because although we can't use the income, getting that second job can help you, one, pad your assets that you may need for your purchase, as well as if you have a high debt to income or we're helping you with your credit scores, those are ways that you can use that money to help pay down debt, okay? So just a quick little tidbit on that. So now we have your gross monthly income, which on this particular borrower is a $60,000 a year salary, and we divided that by 12, which gives us $5,000 a month, all right? So along with knowing your salary, you do want to know, well, what is your debt? even without pulling a purchase without pulling your credit report, you do need to know what are you paying every month. So most people have a car payment. And what's important to know about debt is that we don't go by what the actual balance is. We go by what your minimum monthly payment is. So if you owe $30,000 on a car, that's great, but we look at what that payment is. So for this particular borrower, it was $450. And then they had some credit cards. I just put a cumulative balance here, but you'll take that minimum payment. So whether that's 1 card or 4 cards or 5, whatever that monthly minimum payment is, add them together or give them their own individual line. This particular borrower is $75 a month. Now, you have student loans, or most people may have student loans. Well, if you do, this gets a little tricky, and although I can do a whole video on student loans, it's important to know that whether you are in deferment, whether you're currently still in school, whether you're in forbearance, whether the government told you you do not have to make any payments, if you come to get a home loan, every program requires us that we include a certain percentage of those student loans against your debt to income. The most popular programs will require anywhere from 0.5% to 1%. I tell people to be safe, use 1%, as you always want to know worst case scenario. All right, so if you have $10,000 in student loans, multiply that times 1%, and that is the amount that we will use against your debt to income. Now, as far as being in an income-based repayment plan, although those are great, and some of them show you have no payment or it's a very minimal payment, we can use that, but we can only use that on one particular program, and that's a Fannie Mae conventional loan. So if you're looking at any other loan, you cannot use that income-based repayment plan, and it will bring us back to what the guidelines state for that loan. So again, this borrower had $350 in student loans. And so when we add all of these debts together, it brings us to $875 in monthly debts alone. Now remember that gross income we have up here at the top. We're going to divide $875 by your gross monthly income. So again, all of your monthly minimum debt payments divided by your gross income. For this particular borrower, that brought us to a 17.5% debt to income. Wow, this is a great debt to income. But keep in mind, now you want to purchase a home, which is going to increase your monthly debt. Now, it's very important when you call your loan officer for you to really understand what don't you want to pay a month? What do you want to pay a month on a monthly payment? So if you're comfortable making a $1,500 mortgage, if you're comfortable paying $1,700 a month, you need to have that conversation with your loan officer. That's typically where we start. Because keep in mind, even though sometimes we may be able to qualify someone for a $500,000 loan, they may not want the payment associated with that. So know your goals and know what you want. This particular borrower stated that they didn't want to spend more than $1,500 in a monthly payment for their mortgage. So keep in mind, on a mortgage, it's not just principal and interest. It's principal, interest, your property taxes, your homeowner's insurance. If you have mortgage insurance, because most people aren't putting 20% down, and if there are any HOA fees, all of that are monthly debts that are associated with the property. And although we don't pay your HOA fees, it is counted as a monthly debt against you, all right? So keep in mind, they had a $1,500 want, and so we added their monthly debt with the amount of mortgage they don't want to exceed, which then gave us the new number of $2,375 a month. But again, we must divide it by their monthly gross income, which happened to be $5,000. When we divided that, that gave us 47.5% debt to income. And although that's okay, lenders really would prefer you somewhere between 36 to sometimes 50% on the back end. Do you have some programs like FHA that may go up to 55%? Yes, you do, but that's not a safe calculation because that's very dependent on your program, that's very dependent on your credit score, that's very dependent on the total file profile. What I tell my borrowers is if you have 780 credit scores, been on your job long time, and you have tons of assets in the bank, would an underwriter be more willing to have a higher debt to income? Absolutely. But if you're borderline credit, don't have a lot of money in the bank, and your job history is a little shaky, they may not be so willing to go up to a higher debt to income because that's more risk on the lender. So a safe number is somewhere between, I say, 36 and 45. So just keep that in mind. Again, I never want you, the borrower, to do this on your own because there's things that we look at as loan officer. Are there debts that we can exclude? Is there any advice that we can provide you to get your debt to income down? Is there maybe an installment debt that you have 5 months left on that you're including that we may not have to include? There are certain things that as a mortgage consultant professional that I look at for my borrowers to see how can I help you qualify for what you want to buy. Now the question is, well, what do I do if I don't have my debt to income's high? What can I do? Well, you only have two options. One of them is harder than the other because we cannot change what a borrower makes a month. You can't change that unless you change maybe your position or you change your jobs. You really can't change how much you make a month. So two things have to happen. One, you're going to have to pay down or off some debts to free up that monthly, debt DTI that you have here. Or the next thing that not all borrowers want to do is you got to lower the amount that you want to qualify for. Keep in mind, buying a home or buying your first home is an exciting process, but buying your first home doesn't always have to be your dream home. When I moved here in 2008, a $100,000 to $150,000 home in Texas would buy you a super, super nice home. Well, due to inflation and due where our market is today, those same borrowers that bought that $100,000 house can now possibly sell that home for $200,000 to $250,000. They can take that equity that they've made of holding on to that first home, and now they can buy their second home, or sometimes they can buy their dream home. So my encouragement to you is, if you're renting, you're wasting money, right? Because you don't get that back. And is everyone ready to buy right now? No, because that takes a commitment. Are you ready to stay in this area for a certain amount of time? Are you ready for the financial commitment that comes with home ownership, which means you have to pay for everything that happens in the house? We just had a huge snowstorm here in Texas, and many people are still dealing with insurance claims of pipes leaking and leaks in their home. And I personally had pool damage, bathroom damage, and we have to have the reserves and the money saved in order to pay deductibles or to pay it out of pocket. There are financial responsibilities that come with home ownership, and I think that every borrower needs to understand that and realize that buying a home is great, but you must also be ready for that commitment. So anyways, I hope that this information helps you. I'm going to stop sharing my screen here so I can be bigger on the screen. But of course, it's your girl, #JLoan, coming at you with some mortgage industry helpful information. If you thought this video was great, don't just watch it, share it with someone who's looking to purchase a home, who's knows someone purchasing a home, or share it with a colleague who may be new to the industry and really wants to know about debt to income. If I can help you in any way, again, please follow me, hashtag JLoan. Go and like my YouTube channel. And I'm just so excited. Have a great week. And I will see you next Tuesday for another Mortgage Tip Tuesday. Be blessed. Bye-bye. Bye-bye.